Good afternoon and welcome everybody. My name is Tony Lajeunesse and I am the CEO and President of TL Financial Group. Today's webinar is going to cover financial planning basics. So we're going to touch on some important bullet points that should be taken into consideration regarding the financial planning process. Today's presentation is being recorded. It's also in listen-only mode and will last about 30 minutes. As always, if you have any questions for me, please email me or contact the office to set up some time with me to discuss and answer any of your questions. In this presentation, we're going to take a look at some general financial planning concerns. While there's no such thing as a one-size-fits-all type financial plan, this overview should assist you when you're thinking about your own needs. Now, there's a lot of ground to cover, even with an overview. So here are the topics that we're going to touch on. First, we're going to talk about setting goals. Doing so is really easy and the first step toward developing any financial plan. Then we're going to discuss constructing a budget. We're going to look at creating an emergency fund reserve. We'll touch on insurance protection. In many cases, you may need to incorporate credit into your financial plan, so we're going to discuss some credit fundamentals. We'll also talk about some basic investment concepts, and we're going to also understand pre- and after-tax allocations along with tax-deferred growth that can help you pursue your goals. We're going to talk about saving for college, planning out your retirement, and last but certainly not least, we're going to look at the basics of estate planning. So let's go ahead and get started. One of the first steps in financial planning is setting goals. When you set goals, you're defining your dreams for the future. Some of your goals may be things that you want to do in the not so distant future, like pay off your credit card debt, buy a new car. Other goals may be more distant. Do you want to buy or build a new home? Do you want to start a business, pay for college for a child or a grandchild, or retire early? Making your goals as concrete as possible will help you focus on what's really important, and a goal that's well defined will be easier to visualize and easier to stick with. So to set clear-cut goals, you can use the SMART technique. And the SMART technique is an acronym that stands for specific, measurable, attainable, relevant, and timely. A goal that's specific is one that's clearly defined and described in detail. So precisely what do you want to accomplish? For example, I want to save for my kids' child education is not really a specific goal, but I want to save for the cost of a 4-year education at homegrown university. By the time that your daughter turns 17, that is a clearly defined goal. With a goal that's measurable, you should be able to track your progress and clearly know when you've reached it. So for example, I want to retire early is not a measurable goal, but I want to retire by my 55th birthday. Now that is a goal and a definite endpoint. An attainable goal is realistic and reachable. Goals can be challenging, but you should have a fair chance at achieving them. I want to save $1 million in 5 years is not an attainable goal for many people. But I want to save $1 million in 30 years may be very much attainable type of goal. A relevant goal is one that makes sense to you and reflects your specific needs and your values. Goals are relevant. There are goals that you'll be excited about because they will be important to you. For example, I want to save $25,000 for a down payment. I can own my own home is an example of a goal that might be relevant. You must be able to set a time frame or a deadline for reaching your goal as well. I want to pay off my credit card debt by the end of next year is a goal that has a clear deadline. And then writing down and prioritizing your goals is an essential first step towards putting together a financial plan of action. Now, the first part of putting any financial plan into action requires you to control your flow of money. That's the part where a budget all comes in, right? A budget tracks your income and expenses and helps you direct the flow of the money where you want it to go. Now, to construct a budget, first account for all of your income, and that sounds pretty simple, right? This includes your paycheck plus any income you might have from sources such as rental income or government benefits, interest on money you have in the bank, or investment income. From that, you'll need to subtract your expenses. Expenses can be broken down into two categories. For example, fixed expenses are those that pretty much you have to pay those, right? Such as rent, mortgage payment, car payments and insurance, utilities, groceries, and basic clothing. Discretionary expenses are more optional items such as eating out, entertainment, gifts, and vacations. It can be difficult to get a handle on many of these numbers, especially the expense items. You may want to keep track of them for a while, either with a paper or pen or on a computer software program to find out how much you're actually spending. And remember that not all of your expenses occur on a weekly or monthly basis. Some are seasonal, like holiday gift spending and things like that, or when the heat goes up in December, you have to start paying heating bills and the cost of gas goes up. Others are occasional, like car repairs or getting a cavity filled. It may take several years of tracking some of those expenses to get a really good idea of what you spend what you're spending your monthly average on per year. Then what you do is you subtract your average expenses for a given period or a month or a year from your income from that same period. Is there a positive number left over? If so, you're in the black and you're running a surplus. That's great. A surplus can be converted into savings or an investment in the future. But if you get into the negative, let me go back here, sorry. But if you get into the negative number, right, that's bad. You're in the red or running a deficit. You're spending more than you're making. The only thing that's going to change that equation is either increasing your income, perhaps a second job, or decreasing your expenses, right? It's not brain surgery. And it's the discretionary expenses, the fun stuff, that are the easiest to cut and usually the most painful. So let's look at the bright side. You're running a surplus. One of the first things you want to do with that surplus is create an emergency fund. This is so very important. An emergency fund money that's readily available to meet unexpected expenses. That's what it's there for. It's really the foundation for any successful financial plan. Without money to fall back on when an unexpected expense pops up, you may be forced to tap savings that you earmarked for retirement, college, or another savings goal. But if you have an emergency fund set up, it will be much easier to handle a job loss, temporary disability, or other event that might prevent you from saving for the future or even tempt you to pile up some debt. How much should you have in your emergency fund? Well, a popular rule of thumb is that you should have an emergency fund equal to 3 to 6 months of your living expenses. But should you save 3 to 6 months or 4 or 5 months of your expenses? The amount you should have depends on a lot of different factors, and everybody's different. How stable is your income? Do you work in an industry where layoffs are common, or are you in a growing field? Do you have adequate health or disability insurance? Do you have other assets that you could tap without penalty in the event of an emergency? Where you keep your emergency fund is also really important. Keeping it in a jar is probably not the best idea. You'll want to keep your money in an account where it's readily available, but you also want to receive as high a return as possible. Rarely do you write one check equal to 6 months or even 3 months worth of expenses. So you may only need part of the fund in something as liquid as a savings or a checking account. The balance of the emergency fund can be held in something getting a slightly better return, but something that you can still access in a day or two. That's really important to be able to get that access quickly. Another important part of financial planning is identifying and managing the potential risks that can impact your finances. The value of insurance is that it's a cost-effective way to mitigate and to share the frequently overwhelming costs of various risks. So let's spend a few moments looking at the types of risk you might want to insure against. What used to be called health insurance has actually been replaced with healthcare plans. Most plans provide basic coverage for common medical expenses such as doctor visits, preventative care, diagnostic tests, hospital and extended care, emergency services, and prescription drugs. Auto insurance has two main components: liability insurance and insurance for property damage. And liability insurance provides compensation to persons who would be able to sue you for personal injuries or medical payments, loss of earnings, or damage to their property. Property damage insurance includes collision and comprehensive coverage, which compensate you for damage to your car caused by another auto or by such things as fire, theft, or vandalism. Life insurance offers income replacement to your survivors. It can provide an income tax-free death benefit and can be used to pay for funeral expenses and even medical expenses of last illness. Now, for most of us, our most valuable asset is our home. The most common type of homeowners policy that covers a variety of risks that can cause damage to your home and personal property, medical payments or injuries to occupants and other persons injured by accident while in your home, and loss of theft or personal property. Liability insurance is often your last line of defense against potentially devastating claims for things over which you have very little or no control over at all. For example, you get into a car accident and the other person is suing you for damages and lost pay. Your current liability coverage may be sufficient to cover the entire lawsuit, but this insurance is often called an umbrella insurance because it's carried over with other liability coverage and usually adds $1 million or more of coverage to your homeowners and automobile liability policies. Coverage is provided for you, your spouse, and any relatives living in your household and insured by your primary policies. These policies can range in cost from about $200 to $300 a year. So it's a really low cost to make sure that you're well protected in the Sue type of happy world that we live in, right? You just don't want to hit the lottery in reverse. Now, what if you couldn't work for an extended period of time because of an injury or illness? How would you replace your earnings? Who would contribute to your retirement savings? And educational funds and disability income insurance benefits can be used to preserve your independence, maintain your lifestyle, give you time to recover, provide a chance to retain for another job if necessary, and conserve your asset savings for you and your family. Now, what is long-term care insurance? It's private insurance that pays benefits if you need extended nursing home care. Like other types of insurance, long-term care insurance protects you against specific financial risks. In this case, the chance that the need for a long-term care related illness could potentially wipe out your entire life savings. And we've seen many examples of that probably in our lifetimes already from other people. All right, so let's say now we've established an emergency fund and you've insured yourself against certain risks of your financial security. And to meet your normal expenses, you've planned a budget. But sometimes you need more funds than what your budget might be able to cover at the moment, and that's where credit comes in. So a word of caution here, don't rely on credit to cover your normal living expenses, right? If you do, you could be heading down a path that may lead to financial disaster. If you're using credit to pay for normal living expenses, it should be because it's convenient to do so, not because you don't have those expenses planned for in your budget. So Merriam-Webster's dictionary defines credit as the provision of money, goods, or services with the expectation of future payment. When it comes to financing big ticket items, such as a college education, a home, or even a car, most of us need some sort of loan. There are many times, like shopping for Christmas or going on vacation, when it's just more convenient to use credit in the form of a credit card, right? To make those types of purchases, and maybe you get some really good points with those credit cards too. So how do creditors decide to grant credit? It really depends on how well you meet the 3 C's. Creditors will want to know if you have the capacity to repay the credit that they grant you. They'll want to know about your income and your expenses. Once the creditor determines that you can repay a loan, the next question is will you? So this is a matter of your character, your credit character. To measure this, they'll look at factors that measure your stability, how long you have had the same job and lived in the same place, and if you used credit before. They'll also want to look at your repayment track record. Do you pay your bills on time, basically? Now, particularly for loans of larger amounts, like a car loan or a home mortgage, a creditor might also want some collateral. Collateral is a tangible property that secures the credit extended to buy it. If you default on repaying that loan, the creditor would be legally entitled to take possession of the property as a form of compensation. Not good. Creditors determine your creditworthiness primarily by examining 3 documents. The credit application you fill out with a potential lender will ask you for your personal information. It will also ask you about your income and its sources, and may ask about your recurring expenses and other debts. Your credit card report will give you a potential lender a wealth of information about your payment history, and your credit score comes from a statistical formula that analyzes the information on your credit report, compares your profile to thousands of others, similar profiles, and produces a 3-digit number that predicts your level of future credit risk. The information gleaned from these 3 documents may not only determine whether you can get credit, but also what interest rate and other terms you are offered. Now, when you're granted a loan or use a credit card, you create a debt. Some debts may be small, a minor purchase on a credit card, and may be repaid very quickly. Others are large, like a home mortgage or a student loan, and may take years to repay those. How well or poorly do you meet the repayment schedule for the debt will have an ongoing effect on your credit history and your credit score. Debt may be divided into 2 basic types: secured debt and unsecured debt. Eventually, you may have some of both. Secured debt is debt backed up by a lien on a collateral. So examples include like a mortgage or home equity loan or car loan or a secured credit card. Unsecured debt does not place a lien on any real or personal property to secure it. So examples of unsecured debt are personal installment loans, student loans, and most credit card accounts. When you think about taking on debt, there are several important considerations. The amount that you borrow obviously will have a big impact on the size of your payment, no matter the term or the length of time you have to repay it or the interest rate that you're being charged. You'll need to consider that within a review of your budget. When you're looking at an installment loan, the term of the loan is the length of time you have to repay it. Generally, larger loans have longer terms. While longer terms help make your monthly payment smaller, remember that a longer term also generally results in a higher total interest repayment over the life of the loan. Revolving credit accounts, such as credit cards, they don't have a fixed term for repayment. Instead, a certain percentage of the current balance due is expected each month, and the smaller that percentage is expected to be, the longer it can take to repay the entire balance. And the interest rate you're charged on a debt also affects your total interest you'll pay on the loan. The higher the rate, the greater interest that's going to be charged to you, the more you're going to have to pay. All right, now that we've talked about using credit and the potential for accumulating debt, let's talk about investing and the potential for accumulating wealth. Do you associate investing with speculation or speculating and gambling? Do you think of it as betting on what the market will do or trying to time the market in order to make a quick profit? Or do you think of investing as more of a long haul, methodical saving effort to build for the future? Well, it's actually a little bit of each. Investing involves taking on a certain amount of risk, and it also involves the desire to multiply your money over time. Done properly, investing is a carefully planned and prepared approach to managing your money with the goal of accumulating the funds that you need. And planning your investment strategy is about the discipline and patience that you'll need over time. When it comes to investing, there's a direct relationship between risk and return. That is, in general, as the potential for return increases, so does the level of risk. Or stated another way, the less risk of investment it has, the lower the potential for the return. The investment plan that's right for you depends largely upon your level of comfort of risk, what's known as your risk tolerance. You can't completely avoid risk when it comes to investing, but it's possible to manage it. So there are two key questions that determine your risk tolerance. First, how comfortable are you personally with risk? This is a really subjective measure, and it depends on many factors, including your financial goals, your life stage, your personality, and investment experience. Some investors are comfortable with a high degree of risk. Others can't tolerate very much risk at all, and a lot of people fall somewhere in between. The second key question is how well is your investment plan set up to handle potential losses? The more resilient your overall plan is when faced with potential losses, the more risk you might be able to take on. So for example, time can be a powerful ally, right? The longer you're going to be invested, the more flexible your investment plan might have to be in order to survive setbacks along the way. Now, there are several key terms you'll need to understand when planning your investments. And these three words are probably familiar, but they have a very specific meaning when it comes to investing. We all know we want our money to grow, right? That's not brain surgery. When it comes to investing, growth means that an investment has the potential to grow in value. If that happens, you might be able to sell it for more than what you paid for it. Income comes from regular payments of money. Interest on savings, which is very low at this point in time, is income though. So is interest on a certificate of deposit, a CD. Interest paid by a bond and dividends paid by a stock are all interest. Now, stability, the third potential objective of an investment, refers to protecting your principal. An investment that focuses on stability concentrates less on increasing the value of that investment and more on trying to ensure that it doesn't lose value. As much as we might like to, we can't have it all, right? There is a relationship between growth, income, and the stability of our investments. The more important one of those areas becomes, the more you may have to trade off in terms of the other two. The key is to tailor your investments according to what you want them to do for you and to balance your stability, income, and growth so that you maximize your overall returns at a level of risk that you're comfortable with. Now, before we talk about some specific investment vehicles, let's first mention some really important tax considerations. Your employer may allow you to cover some of your ongoing expenses with pre-tax dollars. Pre-tax dollars are funds that are taken from your paycheck before certain taxes on your pay are actually calculated. So for example, your federal income tax. Your taxes are then calculated on the remaining pay. And this creates a tax savings for you. So for example, if you're in a flat 22% tax bracket and you're allowed to buy a $100 commuter pass with pre-tax dollars, the pass really only costs you $78 in after-tax or take-home pay dollars. The result can mean a lower out-of-pocket expense for you. Some opportunities, if your employer offers them, where you might cover expenses with pre-tax dollars may include paying your health insurance or disability insurance or dental and vision insurance premiums. Your employer may also allow you to contribute pre-tax dollars to a flexible spending account like an FSA for either medical expenses or dependent care expenses. With an FSA, you can contribute pre-tax earnings to the plan and submit qualifying expenses to the plan for reimbursement. And as mentioned above in our example, your employer may allow you to pay certain qualified commuter or parking expenses with pre-tax dollars as well. Your employer may also offer a retirement plan like a 401k plan, 403b plan, 457. What these plans have in common is that they now allow you to elect to contribute a percentage of your earnings on a pre-tax basis. These plans are intended to be used to save for retirement, and they offer advantages that go well beyond the fact that you get to fund them with pre-tax dollars, as we'll discuss later. Another tax consideration is that some specific investment vehicles allow for tax-deferred growth. Whether you're investing in pre-tax or after-tax dollars, tax-deferred growth basically means that you won't owe taxes on the growth of that investment until you withdraw funds from that account. And in other certain cases, qualified withdrawals from these investment vehicles may be tax-free. Some examples of an investment vehicle that qualifies as a tax-deferred growth are 529 college savings plans and prepaid tuition plans. A 529 plan is funded with after-tax dollars, and then what happens is your investment grows tax-deferred until you withdraw the funds, and at that time, if the funds are used for qualified educational expenses, the funds may be withdrawn 100% tax-free. So both traditional and Roth IRAs also allow tax-deferred growth. In the case of traditional IRAs, your contributions are made with after-tax dollars, but they may, if you qualify, be tax deductible on your federal income tax return. So this is important because tax deductibility, tax deductible contributions lower your taxable income for the year that you're saving your money. And funds in a traditional IRA are sheltered from federal income tax until withdrawn. As for Roth IRAs, if you qualify on the basis of your income and you contribute to one, your contributions are made with after-tax dollars and aren't tax deductible, okay? But the good news is that if you meet the certain conditions, your withdrawals from the Roth IRA, including any investment earnings, will completely be tax-free from federal tax. With most of the investment vehicles mentioned, for example, 401k plans, IRAs, and 529 plans, a 10% penalty tax does apply if you take distributions before a certain age or for a non-qualifying purpose. So make sure you examine that before you decide to take that money out. You don't want to get hit with that penalty. So let's illustrate the value of tax deferral. This is really neat. Let's assume you have $20,000 to invest. You put $10,000 in a taxable account that earns 6% per year, and you use a portion of these assets each year to pay taxes attributable to the account earnings. You put the other $10,000 in a tax-deferred account that also earns 6% per year. Now, sorry, I got clicky there. Give me 1 second. Now, assuming that a tax rate of 24% applies in 30 years, your taxable account will grow to $38,000 and $38,104 as you see there. In the same amount of time, your tax-deferred account will have $57,000, $435 in your account. Of course, the funds in the tax-deferred account might be subject to federal income tax when withdrawn, of course, but even if you look, even if you took the entire amount in the tax-deferred account as a lump sum distribution after 30 years and paid tax on the full amount, you'd still come out ahead in this example. At a tax rate of 24%, you'd end up with $43,651. Again, a note of caution, depending on the specific tax deferred vehicle, an additional 10% penalty tax could apply if you took distributions before a certain age for a non-qualified purpose. Additionally, the illustration also assumes a fixed annual rate of return over the 30-year period of time. Of course, in real life, the return on a portfolio is going to vary over those time and over, of course, different conditions. So this is especially true for long-term investors. All right, now that we have some understanding of investing in either pre-tax or after-tax dollars in vehicles that allow tax-deferred growth, let's take a look at a couple of things you might be investing for. Now, for most people, the two biggest life events that they need to save for are college educations for their children funds, and of course, their own retirement. Let's spend a few moments talking about saving for college. Perhaps your potential Harvard graduate is still in diapers, but given the high cost of college, you'd be smart to start a systematic college savings plan now. And one of the options available for saving for college is a 529 plan, as we discussed earlier. Because this savings vehicle offers the advantage of tax-deferred growth, it should be the cornerstone of any college savings program. So what is a 529 plan? A 529 plan is a savings vehicle that is governed by the federal government, but offered by states. Anyone can open a 529 plan. There are actually two types of 529 plans: college savings plans and prepaid tuition plans. A college savings plan, which is the more popular type, is an individual investment account to which you can contribute money to. Your money is allocated to your choice of one of the plan's pre-established investment portfolios, which generally range from conservative to aggressive in their amount of risk. Some actually get more conservative as the child gets older or gets closer to graduating high school and entering college. Returns aren't guaranteed on these types of accounts, but money in a 529 savings plan can be used to pay the full cost. So it takes care of like tuition, fees, room and board, book supplies, think computers, things like that. At any accredited college or a graduate school in the United States or even abroad. So it covers all of that. For certified apprenticeship programs, fees, books, supplies, equipment, pays for that. It pays for student loan repayment. There's a $10,000 lifetime limit per 529 beneficiary and a $10,000 per each of the beneficiary's siblings. And for K through 12 tuition expenses, up to $10,000 per year. So it's pretty good. Almost every state offers a 529 college savings plan, and you can join any state's plan as well in case you don't like the plan that your state offers. The second type of 529 plan is a prepaid tuition plan. As its name suggests, when you join this type of plan, you actually prepay your child's college tuition at today's prices. So the contribution you make today is generally guaranteed to cover a certain percentage of college tuition for tomorrow. However, you are typically limited to your own state's prepaid tuition plan, and your child is limited to the colleges that participate in the plan, generally in-state public colleges. So you really have to examine that before you go down that road. Now, the main benefit of a 529 plan is that your contributions grow tax deferred and earnings are completely tax-free at the federal level when they're withdrawn to pay the beneficiary's qualified education expenses. Note, however, that withdrawals that aren't used for qualified expenses are subject to federal income tax as well as the 10% tax penalty. Additionally, there are fees and expenses associated with both types of 529 plans, so you have to be aware of that. Finally, it's important to note that if you're considering a 529 plan, it generally makes sense to start by checking to see if there's a plan offered by your state. Michigan has one, since that plan might provide favorable state tax benefits to residents. And you should always read the issuer's official statement you got to read it really carefully and consider the investment objectives, the risks and charges and expenses associated with that plan before you invest in it. Now, the other major life event that you need to save for is your retirement. So even if you feel you're too far away from retirement to start even thinking about it, it's really important that you start planning for it now. Many people assume that they can hold off saving for retirement and make up the difference later on, but this can be a really costly mistake. So the further off your retirement is, the more time your investments have the potential to grow, right? So waiting too long can make it very difficult to catch up, and only a few years can make a big difference in how much you'll accumulate. So you can see these examples here. If you invest $3,000 every year, starting when you're 20 years old, and if you retire at age 65, you're going to have accumulated almost $680,000, assuming a reasonable rate return of 6%, and of course, no tax. If you wait until age 35 and start saving $3,000 annually, you'll accumulate only about $254,000. And if you wait until age 45 to start saving, you'll accumulate only about $120,000 by the time you retire. This doesn't mean there's no hope if you're 50 years old and you haven't set aside anything for retirement. It just makes it all that more important that you implement a plan today. Of course, this is the only illustration used to make a point. A carefully constructed cash flow analysis can really help you run different scenarios based on your unique circumstances. So we run cash flows for our clients all the time, and it's like the cornerstone of what we do. It's so important because you have to have the right expectation for the road that you're on to make sure that you are, like I said, setting that expectation correctly so you're not caught off guard when you're getting ready to retire. Now, before you can start planning for your retirement, you need to ask yourself 3 basic questions. What kind of retirement do I want to plan for? When do I want to retire? And how long will retirement last? Close your eyes for a second and picture your own retirement. Whether you see yourself on a golf course, on a boat, a hammock, or simply in your own living room, most of you probably imagine some degree of financial independence. To a large extent, maintaining financial independence in retirement depends on the lifestyle that we want. And you have to have a thought about when you'd like to retire. It's really important because the earlier you retire, the shorter period of time that you're going to have to accumulate these funds that you're going to need. And the longer the period of those dollars will need to last. Although you can retire anytime, most people wait until they're eligible for Social Security retirement benefits. You can't start receiving your benefits until you're at least age 62. That's at the earliest. Or you might want to wait till your full retirement age, which might be 66 or 67, depending on the year that you were born. Also, you're not eligible for Medicare health coverage until age 65. So if you want to retire before then, you're going to want to plan and prepare to pay for your own health care. Now, as we just discussed, the earlier you retire, the longer period of time your funds will need to last. But how long should you plan on your retirement lasting? Keep in mind that life expectancy has increased at a steady pace over the years and is expected to continue to increase. The point I want to make is that for many of us, it's really not unreasonable to plan for a retirement that's going to last at least 25 years or more. And that's another reason why cash flow planning is so important. You want to make sure you don't run out. One of the best ways to accumulate funds for your retirement is to take advantage of special tax retirement savings vehicles. Some of these, such as 401k plans, can be very powerful tools because your contributions come out of your salary pre-tax and reducing your overall current taxable income, also known as a tax deferred, actually tax deferred until it's withdrawn. And 401k plans can include employer matching contributions, free money, which should make them your first choice in saving for retirement. You may also be able to make Roth contributions in your 401k. Since they're after tax, not pre-tax contributions, Roth 401ks contributions don't provide you with an immediate tax savings, but they do allow you to make withdrawals completely free from federal income taxes under certain circumstances. Traditional IRAs, like 401ks, feature tax-deferred earnings growth and can lower your current taxable income if you qualify to make tax-deductible contributions. And like a 401k funds and a traditional IRAs aren't taxed until they're withdrawn. Roth IRAs, like Roth 401ks, don't permit deductible contributions, but of course they allow you to have that tax-free withdrawal under certain conditions. Since these vehicles are intended to help you save for retirement, a 10% additional penalty tax applies if you decide to withdraw that money before you reach age 59 and a half, unless under certain exceptions, or certain things that may apply to you, like a disability. Now, any complete financial plan should also involve estate planning. So let's look briefly at some of the basic concepts you'll need to understand to achieve your estate planning goals. And here's a few of the topics that we'll be reviewing. First, we'll look at intestacy and why you might want to avoid it. Next, we'll consider the importance of wills and trusts in the estate planning process. Then we'll discuss incapacity and what you can do to prepare in case incapacity should strike you. Now, let's say you die, leaving $50,000 in a savings account. Who does that money go to? Without instructions from you, the money would go to where your state intestacy laws direct it to go. Intestacy laws vary from state to state, but here you can see a typical pattern of distribution. 50% of your property goes to your spouse and 50% goes to your children. Remember, it may be different in your particular state. The biggest issue with intestacy is that your actual wishes are irrelevant. Okay, that's really important to know. Without an estate plan, regardless of your wishes, your estate would be divided between your spouse and your children. There are many potential problems with allowing your property to pass through intestacy, and intestacy can be particularly problematic for unmarried couples, since intestacy laws generally will not include an unmarried partner in the distribution of the property. So there's a really simple way to avoid this though. You can create a will. A will is probably the most vital piece of anyone's estate plan. A will is a legal document in which you direct how your property will be dispersed when you pass away. It also allows you to name an executor who will carry your wishes, which are stated in your will. In addition, your will lets you name a guardian for your minor children. You can use your will to accomplish other estate planning goals as well, such as tax planning. To be valid, your will must be in writing and signed by you. Your signature must be witnessed, and these requirements are important because if you aren't careful, your will may be invalid. So see an estate planning attorney to take care of this for you, and try to avoid the do-it-yourself type of solutions. Seeing a good estate planning attorney is a really good thing to do. And finally, let's talk a bit about incapacity and why and how you should plan for it, especially as we get older. Incapacity describes a condition in which you are legally unable to make your own decisions. Think for a moment when that might happen. If, for example, you were to become the victim of an accident that puts you in a coma for several months, how would your doctor know what medical treatments you would want or not want if you can't speak for yourself? How would your personal business be transacted if no one was there or authorized to sign your documents? What would happen is this. Someone would have to go to the court and get legal permission to do things for you. And that person, who is called a guardian and is usually a close family member, such as a spouse or a child. Next, they would also have to go back to the court every time for permission needed. As you can imagine, that might be quite burdensome for the guardian. Further, without any prepared instructions from you, your guardian might make a decision that would be different from what you would want or have decided. So fortunately, these situations can be avoided with the proper planning, right? Healthcare directives allow you to leave instructions about the medical care that you would want if conditions were such that you couldn't express your own wishes. And property management tools ensure that you can have your financial affairs taken care of for you in the event that you become incapacitated. So once again, an estate planning attorney can set up what's best for your needs. As you can see, the estate planning portion of your financial planning is really super important, and it's oftentimes procrastinated. So it's a lot easier to avoid a problem than it is try to fix one after the fact. So don't delay on your estate planning. Get a will, power of attorney, and medical power of attorney and financial power of attorney. Those are really important to have. All right, we covered quite a bit of financial planning basics. I hope a lot of this helped you today and helped educate you on all of these bullet points that we went over today. Oftentimes it's difficult to put your financial plan together on your own, and that's really where we come in. So please contact us if you have any questions, or if you'd like for us to put together a complete financial plan for you. That's what we're here to do for you. Really help you dot the I's, cross the T's, and take a holistic approach to your financial planning needs. Again, if you have any questions or if you'd like to set up some time with me, please give me a call or email me, and I'd be happy to help you out. Thanks a lot. Have a great day. Enjoy and be safe.